When we're looking at oil, we have a scenario here where oil again likely holds steady. We see all this capex spending from the AI trade and everything going on there. And to me, that's really propping up the economy. You mentioned at the start how consumer spending is starting to fall off a cliff. I think you'll get a small rebound now that oil has come down significantly, but I don't think it's going to rebound to pre-Iran war levels, mainly because the consumer continues to be under pressure. Now, the GDP, like you said, is partially an import-export issue there. But I also think that there's an underlying issue where you have a majority of Americans struggling, getting deeper in debt, still trying to spend, but running up credit card debt. We see credit card delinquencies, auto loan defaults starting to rise more and more. And that tells us that eventually late in the year, we start to see weakening in the economy, and that is going to be a trigger for oil. I could see by December or maybe early in 2027, oil down to $50 a barrel. And that's going to be the negative here is that, there's a lot of talk about how we want to get oil prices down. If you see it getting down to $50 a barrel, there's something majorly wrong in the US and global economy that's destroying demand. And that again will signal likelihood of recession. Overall, I would expect inflation to moderate, but I think it's important for us all to remember that inflation was already going up prior to the war between the US and Iran and the spike in oil. So I think we have to be understanding that inflation is not transitory here. It's not just an oil story. Sure, oil added to it. It pushed it much, much higher than it probably would have been, but it's still an underlying issue in the US economy, and it's not likely to go away anytime soon. And I think this comes back to where we were talking about potentially late this year, early 2027, where we get into that stagflationary environment where we start to see inflation maybe not down to 2%, but it could be around 3%. But at the same time, the economy slowing more and more and potentially going into a recession. And again, that's the definition of stagflation. And I do think we're still on course to see that year end or 2027. And I think we have to look at it like this, is that the spending alone, you have government spending that obviously hasn't really stopped or slowed down. It's accelerated, if anything, with the cost of the war. But obviously we're looking at, military spending, rebuilding the military aspects that were used up in the Iran war as well as in Ukraine. And so that has to be built up. That's stimulative. Then you have the capex from the AI trade that's going on. That's unlikely to slow majorly before year end. But I do think you are starting to see the signs in the AI trade that things are getting long in the tooth. And some of these stocks like NVIDIA and Broadcom are already showing signs of a potential bear market. I think the market misread the Federal Reserve speech, the press conference where Kevin Warsh was hawkish, but I'm not buying it. I think it was a majority of an act that he was putting on. He has to put on that strong force to say he's going to tackle inflation. But we know that President Trump said that he would never appoint anyone who wasn't willing to cut rates. And that puts us in a position where Kevin Warsh had to be hawkish. He had to kind of say, hey, we know inflation is high. We're going to tackle it. But at the same time, I know the markets are pricing in a rate hike before year end. I don't think we're going to get it. And I think he is going to become more and more dovish over time. And remember, he's the one that's floated ideas about redoing the inflation gauge and getting rid of outliers of inflation. And so you take out like the outlier popping up and all of a sudden inflation looks a lot lower, and it gives you a case for the Fed being able to cut rates when maybe otherwise they wouldn't. The one thing that I'll say about the former Fed regime is that if there was any hiccup, there was always a Fed official that was giving a speech or the press conference after the Federal Reserve decision. It was always a way for the Fed to calm the markets down or correct the markets if they were making a misinterpretation of what the Fed was doing. And we saw Jerome Powell, a master at this, always calming the markets down. You would see initially some uncertainty after the rate decision, and then he would come on, give a press conference, and the markets would generally go up because of his demeanor and because of his calming nature. And so anytime you cut that out or somewhat of that, I do think it raises the odds of more intraday volatility and even intra-week and month volatility. And I think it's for us as a trader, I'm more of a shorter term trader. That actually is a positive, but I think for the retail investor, it does bring up more potential risks and volatility. So as soon as the economy starts to stall and slow, I expect a rate cut. I think the markets will already see this in the future. We'll start watching the 10-year yield and seeing where that goes. But my guess is no action by the Fed cut. I think the markets will end lower than they are currently. It's hard to know fully is going to tap out. I do think we're seeing lots of signs already of it tapping out, but I would generally expect a lower than now close to the markets. And then I think we're going to start to see more downside in 2027. Historically, when the Fed actually starts cutting cutting rates, that's when the market actually starts selling off. And most retail investors, they're under the interpretation that lower rates of Fed cuts are positive. But when it's combined with a slowing economy, the fear starts to become pervasive. Oh my goodness, we're going into a recession. The Fed is behind the ball. They should be cutting more. And that's where you see investors starting to run for the hills. And especially at these levels where everything's priced to perfection. We look at all of these metrics in the AI trade and we're seeing, everything's priced like the demand will never slow. The capex spending is just going to go up. We're starting to see cracks in that narrative. I still think that's a possibility. And we did get a down one of almost, I think it was about on the S&P about 7 or 8% before this latest push up. I still think that is a possibility. But what I'm talking about in 2027 and beyond is a much larger corrective move where we could actually see that 40 or 50% drawdown. But yes, short term, absolutely. Basically, if you have a correction in the AI stocks of 20 or 30%, which is kind of the run of the mill, just pullbacks in those stocks, that would be enough to take the stock market, at least the NASDAQ, down well above 10% down, maybe even 20%. I think that, again, as we get further down in this cycle, there is going to be some major questions asked about the sustainability of the capex spending and how far things have gone. And think about the rush of liquidity. I mean, we've seen SpaceX come public. All right. Now we see SK Hynix is dropping $29 billion of shares that they need the U.S. investor to buy. We have Anthropic, OpenAI, Perplexity. Google tried to sell or is in the process of selling $80 billion. I mean, eventually the liquidity in the system is going to dry up. And I think we're already starting to see that. And at some point when it runs out, when you get one little tidbit of negativity, that's when the markets can fall. And think about this, just in the last few days before the Micron earnings, we had a little bit of questions on the AI trade, and look at how fast the markets went down. I mean, we literally woke up to a 3.5% drop in the NASDAQ. And it's always important to kind of not focus on the shiny thing in the room. And right now, Micron is the shiny thing. Couple things to note is that ultimately they are projecting out all this grandiose promises about AI demand for memory. Prices are going to stay at crazy levels with margins at 85, 90%. I don't buy it. And I'll tell you, we're already seeing other companies starting to pursue DRAM and memory production. We're seeing other plants being built. And granted, that's not going to come online for a year or two, but it will come online. And these things are cyclical. You will see Micron down 75% within the next 12 to 18 months. And keep in mind, Micron's the shiny thing, but look at NVIDIA. All right. Is the AI trade really okay right now? And so granted, Micron, they were awesome. That move is incredible for $1 trillion+ company to jump like that. But if you look at the underbelly of the bigger players, not the shiny thing, but the actual real backbone of the AI trade, it is starting to falter and eventually it will spill over to Micron. I do think that we're seeing some money move into the bond market. If we look at the 10-year yield, the 10-year yield is actually breaking down here. So again, we're starting to see, this is telling us that there's a rise in interest in buying into bonds right here, that interest rates are starting to come in. This was a great breakout and now it's failing. Now, again, this is two ways to take this. Number one, oil coming in tells us inflation is coming down. So expectations of rates being up so high don't need to be. But also, is it telling us that there potentially is the bond market saying a slowdown is coming late this year or early 2027, and maybe we won't get rate hikes, which is what I just talked about before. So the bond market may be leading us here just a little bit. Now, in terms of money rotation, the US dollar is king again. There's definitely a resurgence in the US dollar, which is also partially why we've seen gold and silver take such a massive dump. But for me, I'm just looking at rotational capital, right? I mean, we look at, again, this is one I've talked about before, but I'm going back to old trusty. I know people are like, oh, these stocks are so boring. Who cares? Yeah, but it pays a 10% dividend. And it's at literally at multi-decade lows on the chart of ConAgra. People still have to eat, even in recession. And so, if someone's going to pay me 10% and I have upside potential on the stock, I'll put a little bit of money to work in these type of names. The key here is, and listen, I know I upset people by talking about it going down to the 50-ish level, give or take, and I'm starting to get ants in my pants to buy silver, right? Now, the rebuttal I always hear, right, is that, but, inflation adjusted silver should be so much higher. You're 100% right. But remember, folks, silver, gold, that In the short term, things move on emotion, which is right now fear, and that drives price below where it should be. And just like greed, when we were at 120, you could argue that it shouldn't have been up there that quickly. Longer term, fundamentals absolutely matter. And so again, obviously I'm looking to be a buyer on gold around 3,500, but silver around this $50 level where I feel comfortable that it's at a discount to where it should be over the longer term. And I'm starting to get very interested in being a buyer. I'm not expecting silver to just rip up to 120 again after it gets to 50, right? There's a lot of technical damage. People that bought in at 100 are going to be panicking when it gets back to 100 to dump into that and say, thank goodness I'm back to my break even. That's human psychology as well. When we get crushed on a trade, we're just happy to get out break even, and you will see some of that. So it's going to have some work to do to get back to the upside. But I do think, again, once we get up there to that 120 level and break out, you'll see 150 and 200 very, very quickly again. But again, I'm giving myself a little leeway on this call. Let's give it till 2029, 2030. That's really only 3.5 years away. It's not that far away.